Canada just walked into a fight it wasn't ready for. A fight against the world's second largest economy. And now, China isn't just retaliating, it's shutting down entire industries overnight. Billions of dollars in trade, vaporized. Farmers, fishermen, and manufacturers on the brink. So, what exactly happened? And more importantly, did Canada just hand China the perfect economic weapon? Keep watching, because this story isn't just about tariffs. It's about a miscalculation that could permanently reshape Canada's economy. Ottawa imposed tariffs on Chinese steel and aluminum, ranging from 25 to 45%, without securing alternative suppliers or reinforcing domestic production. The rationale? Curbing unfair trade practices. But the real driver was external pressure. According to a Bloomberg analysis, U.S. policymakers had been pushing allies to curb reliance on Chinese metals, citing national security concerns. But here's where the miscalculation begins. China was never the primary source of Canada's steel imports. Only 5% of Canadian steel came from China in 2023, according to Statistics Canada. Meanwhile, China was Canada's second largest trading partner overall, accounting for nearly $100 billion in total trade. By striking first without a comprehensive economic shield, Ottawa set the stage for retaliation it wasn't prepared to absorb, and Beijing didn't wait long to hit back. Within weeks of Canada's tariff announcement, China imposed import restrictions on key Canadian agricultural goods worth over $7 billion annually, according to the Canadian Agri-Food Trade Alliance. The biggest blow? Canola oil. China accounted for 40% of Canada's total canola exports. Then, overnight, Beijing suspended all new purchases citing pest concerns. But the timing was suspect. No other major buyer raised similar complaints. The result? Canada's canola exports to China plummeted from $2.7 billion in 2018 to just $800 million by mid-2024, leaving farmers with surplus crops and declining prices. Meanwhile, China was already shifting its purchases elsewhere, signing new contracts with Russia and Kazakhstan, locking in supply chains that would permanently exclude Canada. And that was just the beginning. Ottawa assumed trade disruptions would be temporary. It underestimated how quickly China could reconfigure supply chains. Take barley. Before the sanctions, China bought 90% of Canada's barley exports. After Beijing imposed an 80.5% tariff on Canadian barley, the sector collapsed. By 2024, exports had fallen from $1.5 billion to just $200 million, according to the Canadian Grains Council. Farmers scrambled to find new markets, but Australia, China's new primary barley supplier, had already filled the gap. Similarly, pork exports nosedived from $514 million in 2019 to just $80 million by mid-2024. China's ban on several Canadian processing plants, citing veterinary concerns, coincided with increased pork imports from Brazil and Spain. Ottawa could protest all it wanted, but the reality was clear. China's market was already gone. Agriculture was particularly vulnerable because Canada exports 70% of what it produces. Unlike the US, which has a massive domestic market, Canada relies heavily on foreign buyers. China was its second largest agricultural market after the US, until it wasn't. Farm bankruptcies surged 35% in 2023, the largest spike since the 1980s farm crisis. According to Farm Credit Canada, livestock and grain farmers saw their revenues drop by as much as 50%, with the prairies hit hardest. And when farmers cut back, the entire rural economy suffers. Equipment suppliers, trucking companies, grain processors. The government scrambled to negotiate new trade deals. But redirecting billions of dollars of agricultural exports isn't something that happens overnight. And that wasn't even China's most aggressive move. A 100% tariff on Canadian beef and pork effectively erased one of Canada's most lucrative export markets. The pork industry alone was projected to lose over $400 million in 2024, according to the Canadian Pork Council. China cited concerns over ractopamine, a feed additive banned in China but legal in Canada. But the timing was strategic. Beijing imposed the ban just as Canadian producers were recovering from pandemic-driven losses. And it's not just about lost sales, it's about reputation. Canadian beef and pork had been premium exports in China for decades. With China now sourcing from Brazil and Argentina, Canada's agricultural reputation has taken a permanent hit. But China's next move hit even harder. In late 2024, China banned all Canadian seafood imports, citing quality concerns. The impact was devastating. British Columbia's seafood exports to China were valued at over $1.1 billion annually, accounting for nearly 80% of the province's total seafood trade. Lobster and crab industries, once thriving due to Chinese demand, collapsed almost overnight. Lobster prices fell by 40%, forcing many fisheries to shut down. In Nova Scotia, seafood processors saw revenue plummet by over 50%. According to industry experts, many small operators won't survive past 2025. What's worse, China has already inked new seafood deals with Russia and Norway. The market Canada spent decades building is now gone, and the fallout is about to get even worse. While Canada was struggling to find new buyers, China secured a landmark grain import deal with Ukraine, further squeezing out Canadian producers. According to Bloomberg, China signed a $3.6 billion agreement in early 2024 to import 8 million metric tons of Ukrainian barley and wheat annually. This wasn't just about grain, it was a strategic pivot. Ukraine's exports to China surged 53% in the first quarter of 2024, while Canada's market share collapsed. Canada had long relied on China as its biggest barley buyer, exporting over 2.5 million metric tons annually before tariffs. But after Beijing imposed 80.5% tariffs on Canadian barley, sales plunged by over 90%, according to the Canadian Grains Council. With Ukraine now firmly in place as a primary supplier, China has permanently rerouted its agricultural supply chains, leaving Canada with excess crops and no major buyers. This isn't a temporary disruption, it's an economic realignment. China wasn't just a large buyer, it was the buyer. In 2022, Beijing accounted for 41% of Canada's total agricultural exports, according to Agriculture and Agri-Food Canada. When China walked away, Canada scrambled to redirect over $8 billion worth of goods. But global markets were already saturated. Ottawa looked to India, the Middle East, and Southeast Asia as alternatives. But with China aggressively expanding its trade deals with Brazil, Russia, and Ukraine, Canada struggled to secure new contracts. The Wall Street Journal reports that even when Canadian exporters found buyers, they were forced to sell at a 20 to 30% discount due to oversupply. Meanwhile, Australia, which recently mended ties with China, saw its barley and wine exports recover to pre-sanction levels, leaving Canada at a severe disadvantage. The result? Billions in lost revenue, mounting surpluses, and collapsing farm incomes. And it's not just agriculture that's suffering. Canada's entire export economy is feeling the strain. Canadian farmers are facing an economic crisis not seen since the 1980s agricultural downturn. According to Farm Credit Canada, farm bankruptcies jumped 35% in 2023, and early 2024 figures suggest an even sharper increase. Major agri-businesses are also struggling. Viterra, one of Canada's top grain traders, reported a 47% drop in earnings in the first quarter of 2024. It's not just raw exports. Food processors and supply chains tied to Chinese demand are collapsing. Canada's seafood industry, which relied on China for 79% of its lobster exports, has been hit with over $1 billion in lost trade due to China's ban, reports Reuters. Port facilities in Halifax, previously bustling with shipments to China, are now sitting half empty. And as farmers suffer, rural economies buckle. Machinery sales have declined, fuel costs remain high, and local businesses that serve the farming sector, everything from feed suppliers to equipment dealerships, are reporting steep revenue losses. This is a full-scale economic contraction. As if losing China wasn't bad enough, the United States, Canada's largest trade partner, is now tightening the screws. The Trump administration has reintroduced 25% tariffs on Canadian steel and aluminum, a move that Bloomberg estimates could wipe out $4.2 billion in Canadian exports annually. It's a 1-2 punch. Canada is losing access to China while also facing new barriers in the United States. According to the Financial Post, Canadian manufacturing output contracted by 2.8% in the first quarter of 2024, with the automotive and steel sectors seeing the steepest declines. Job losses are mounting in Ontario, where over 10,000 manufacturing positions were cut in just the first 3 months of the year. And it's not just tariffs. With the United States focusing on domestic production, Canada is seeing reduced demand for its exports. American firms are turning to Mexico and Vietnam for cheaper supply chain alternatives, further sidelining Canadian manufacturers. Canada's 2 largest trade partners are now erecting barriers, and there's no easy fix. Canada's government has announced a $2.1 billion emergency aid package for affected farmers and industries, but it's a short-term fix to a long-term problem. China's trade shift isn't a temporary setback, it's a restructuring of global markets. Even if relations improve, China has already built new supply chains with alternative partners, meaning Canada's lost trade may never fully recover. Meanwhile, business confidence in Canada has plummeted. A survey by the Canadian Chamber of Commerce found that 68% of businesses expect declining revenues in 2024, citing supply chain disruptions, higher export costs, and uncertainty in trade policies. With China and the United States now setting the rules, Canada risks being caught in a geopolitical crossfire it can't control. And here's the hard truth. Ottawa initiated this trade conflict without an exit strategy. Now industries are being left to fend for themselves. So what's next? Look at the numbers. $11 billion in lost trade, 35% more farm bankruptcies, and a shrinking export market. Reuters reports that Canada's global trade deficit hit a 20-year high in early 2024, reflecting how much damage these economic battles have done. With China's new trade deals locking Canada out of key industries, recovery isn't just uncertain, it may be impossible. Even if Ottawa reverses course, China isn't waiting around. Its supply chains are diversifying, and its reliance on Canada has already been replaced by Ukraine, Brazil, and Australia. This isn't just a trade dispute, it's an economic displacement, and Canada's window to reclaim its position is closing fast. But what if this is only the beginning? Because China's next move might not just push Canada out of global trade, it could reshape the entire global economy. So here's the question. Is Canada's economy on the brink of a long-term decline? Can Ottawa reverse course before it's too late, or has China already moved on? Drop your thoughts in the comments because this isn't just about Canada. This is about how global power shifts are happening in real time. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.